For every human being, what is considered the second God is none other than money. All humans must seek money in various ways to sustain their lives and fulfill their desires. So today, I'd like to share insights about money and how to earn it. Warren Buffett once told his friend at the age of 13, "If I'm not a millionaire by the time I'm 30, I'll jump off the tallest building in Omaha." As we all know, what happened next? This ordinary child went on to achieve extraordinary success. The answer lies in investment. You might say, "I don't know how to invest." But in reality, that's not true. We invest in our lives every single day. Amateur invests her time in her family and, as a result, gains a happy household. An employee invests time in their work and earns a salary in return. An entrepreneur invests capital into their business and reaps profits. What I'm saying is, investment exists in every aspect of our lives. Warren Buffett's mentor, Benjamin Graham, understood the fundamental principles of daily life investment and wrote the book The Intelligent Investor in 1949. Even today, this book remains highly relevant. That's why it's regarded as the Bible of investing. Warren Buffett himself recommended this book, stating, "This is by far the best book ever written on investing." So what's inside this book? Let's explore. In this video, I'll share 8 key lessons that will answer many of your investment-related questions. Let's begin. Lesson 1. The investor versus the speculator. In the world of investing, there are 2 types of people, investors and speculators. What we often assume to be investors are actually speculators. What's the difference? A speculator makes decisions based on short-term market trends, relying on luck and predictability. An investor, however, bases decisions on fundamental analysis. A true investor possesses 3 key qualities. 1. Analytical decision-making. Their actions are not driven by market trends but by deep analysis. Importantly, they analyze companies, not the market. Why? Because predicting the market is nearly impossible, but a company's performance can be assessed. 2. Capital preservation. They prioritize safeguarding their principal investment. 3. Long-term exceptional returns. They aim for sustained outperformance over time. Those who lack these qualities are not investors. They are market speculators. Graham's advice: if you truly want to invest and change your destiny, don't be a speculator. Become an investor. Why? Because the universal truth in investing is that your predictions will eventually be wrong. Lesson 2. Defensive, aggressive, and enterprising investors. In real life, there are 3 types of investors: defensive, aggressive, and enterprising investors. The aggressive investor is greedy and seeks high profits by investing in risky funds. The defensive investor plays it safe by investing in low-risk funds. The enterprising investor balances their investments wisely between both approaches. Many people think investing is about getting rich quickly, but the truth is, just like any other work in the world, it requires patience. While impatience might bring higher short-term gains, sudden losses could be devastating. Therefore, you must carefully consider what kind of investor you want to be. This depends on how much time you have and your primary goals. If you have ample time and want to be a full-time investor, you can adopt the enterprising investor's portfolio approach. Being enterprising requires extensive analysis, but most people don't have time for this. For them, following a defensive investor portfolio is better. While returns may be modest, performance will remain stable. Graham never recommended becoming an aggressive investor because that path resembles gambling. It can make you rich overnight or ruin you just as fast. Lesson 3. The defensive investor's portfolio. If you choose to be a defensive investor, here are Graham's recommended company criteria. 1. Sufficiently large companies. Invest in big, reputable firms that can provide stable long-term returns. Small companies are riskier. 2. Strong financial condition. A company's current assets should be at least double its current liabilities. 3. Earning stability. The company should have consistent earnings without losses for at least 10 years. 4. Dividend record. It should have paid uninterrupted dividends for 15 to 20 years. 5. Earnings growth. Minimum 33% growth in earnings over the past decade. 6. Moderate P/E ratio. The The stock price shouldn't exceed 15 times average earnings over 20 years. Overpaying reduces future profits. Most importantly, defensive investors should avoid growth stocks and maintain a 50-50 portfolio. Buffett and Graham taught us to be patient, defensive investors with modest expectations. But if you're a full-time investor seeking higher returns, the next lesson is for you. Lesson 4. The enterprising investor. An enterprising investor's portfolio requires 4 key traits: patience, discipline, eagerness to learn, and significant time investment. To outperform others with lower risk and higher returns, you must do things differently. 1. Be contrarian. Buy when others are selling. Sell when others are greedily buying. 2. Invest in growth stocks. These are companies with superior product services that outperform competitors. They typically have high PE ratios but lower dividends. Thorough research is critical. Correct picks yield great returns, but mistakes lead to losses. Not recommended for defensive investors. 3. Buy bargain stocks. Look for quality stocks of reputable companies trading at discounts due to temporary market factors. 4. Special situations. Example, Ruchi Soya was a failing company until Patanjali acquired it. Now shares trade above 1,000. Mergers, acquisitions, or turnarounds can generate exceptional returns. Lesson 5. Mr. Market. The most critical factor in investing is the market. This much we all know. However, due to market volatility, many people fear investing. To simplify this complexity, Graham introduced the concept of Mr. Market in his book. Mr. Market's mood swings daily. When optimistic, he inflates stock prices far above intrinsic value. When pessimistic, he crashes prices below true worth. A wise investor sells when Mr. Market is euphoric, buys when he's depressed. Yet most do the opposite, buying high and selling low. Graham's advice? Ignore Mr. Market's mood swings. If you're a long-term investor, short-term fluctuations shouldn't affect you. Only invest when prices are low relative to intrinsic value. Lesson 6. Margin of safety. If you buy a product worth $100, would you pay exactly $100? Probably. But an engineer building a bridge rated for 20,000 kilograms doesn't design it to just hold 20,000 kilograms. They add a safety buffer. In investing, this buffer is called margin of safety. Graham emphasized that avoiding losses matters more than chasing gains. How Moz works. Price is not equal to value. Price equals what the market charges. Value equals a stock's true worth based on earnings, assets, and dividends. Example, a stock's intrinsic value is $50. Most buy at $50, hoping it will rise. But Buffett wouldn't touch it unless priced at a 30-40% discount. Moz minimizes risk and enhances returns by ensuring you never overpay. Lesson 7. IPO investing. In an IPO, companies sell shares through investment banks, often at inflated prices. Retail investors then trade these shares in the secondary market. Why avoid IPOs? 1. No margin of safety. Companies rarely underprice shares. 2. Hype-driven. Prices often spike initially, then crash post-lockup. 3. Graham's warning. IPOs are speculative. Stick to established stocks with proven track records. Lesson 8. Inflation and market investing. Why invest in stocks instead of parking money in fixed deposits? Because of inflation. A $10 loaf of bread today may cost $20 in a decade. FGO 5-6%, but inflation averages 2-3%, eroding real returns. Wealth building rule. Your investments must outpace inflation. Stocks historically deliver 7-10% annual returns, preserving purchasing power. This video covers important topics from The Intelligent Investor, one of the best books on investment. I believe you'll gain valuable knowledge and financial insights from this video. Please like and subscribe to the channel And don't forget to hit the notification bell. Have a good day.